What's going on, everybody? Hope you're having a wonderful day. I thought I'd follow up and talk about a few other places to make money that are in the stock market that are fairly low risk. Um, Obviously, we got the ongoing um, war in U.S. and Iran, um, and that in the Middle East, and the closure of Strait of Hormuz, and how that affects the oil prices and and how the stock market traders have reacted to the oil prices and that sort of thing. First of all, so right now, like as this U.S. Iran, I mean, it's a Israel, U.S. slash Israel versus Iran military war, and that's it's been affecting the stock market in the short term, and it kind of remains to be seen how long that's going to go. Trump has like sent a 15-point plan to Iran and to basically end the war, and apparently Iran has rejected that plan, and so I guess it's kind of a ongoing efforts to end that. But anyway, let's talk about how to make money in the stock market, even with some things that are going on in the market that are challenging to deal with: war and Strait of Hormuz closure, and interest rates being where they are, 3.5 to 3.75%, and tariffs. So we have a few things that are kind of making stock market investing slightly more challenging than many times they would be. But anyway, so I talked about last time several places that I've put money, and then I'll continue here with places I put money. And then I didn't talk about this one. I do have some money invested in this ETF. This is a Amplify CWP Growth and Income ETF, and the ticker is QDVO. And I'll talk about these about 1 year in, or this ETF in the last year, the NAV has appreciated. I mean, it's mostly concentrated on technology stocks. So as you can see, the sector weightings are over 44% technology stocks, and Nvidia, Apple, Alphabet, Microsoft Corporation, Amazon, Meta, Tesla, Broadcom, Amplify, Samsung, Netflix. All these top 10 names are technology companies. And then they've also got communication services, consumer cyclical, Amazon, and then some healthcare, consumer defensive, financial services. But as you can see, this one's kind of mostly in the technology sector. And in the technology sector, we've kind of dealt with, I would say we've got about so this ETF had a peak right here at about 10.29 at 30.40, and then it's dropped. It's dropped significantly from its peak to today. It closed at 27.23. So it dropped nearly three points from the NAV from the peak, but this isn't just in this ETF alone. This is kind of how the market has been behaving in terms of technology for the last 6 months or so, and there's been kind of a so it might even be a good time to buy this, because there's been some sell-off in the Nasdaq in the last 6 months, really since kind of late October, and then there's just been a sell-off, and so but anyway, this ETF has a expense ratio of 0.56%, and that's taken out over the course of a year, and the yield is 10.65%. And so a twelfth of, and it pays monthly, and so you're going to get a twelfth of 10.65% every month. And you'll have to, learn exactly which day they'll give that, but they'll um, they'll have an exit dividend date, record date, and then a pay date. And so those are the times like if you have the money in the ETF at the ex dividend date, then they'll and it's usually the same day as the record date now, and then then you'll get paid. It's usually within the next week for most of these income ETFs. Um, so the course of 1 year, the NAV has gone up. If you hold on for a whole year, it's gone up 5.71%, and that's in addition to the 10.65% broken down into over the course of 12 months. So a twelfth of 10.65% is what you'll get monthly. The next one I thought I'd look at is this one is a popular. It's a Realty Income Corporation. They're involved in realty and realty income, and so they've kind of over the course of the last year. This one there isn't a there's no expense to buy the stock. You might get a very slight expense from your brokerage, but there's no expense to buy the stock for most brokerages these days. However, this ETF pays monthly, and it's going to pay 5.35%, and that is over the course of 12 months, so a twelfth of 5.35%. And over the course of the past year, this has gone up 7.92%, and it was going up. It was kind of staying fairly. It was kind of going up and down, and then this one is in the U.S.-Israel versus Iran war started at the end of on 2/28, so that's where it peaked. It peaked at right around 60. This rating is a peak and it raised it. So peaked up here and looks like it got up in the upper 60s, and then this is March here, and then a lot of the stocks in the stock market have sold off a bit in March after the war started, and so it dropped about 10% or so since the peak at the end of February this past February 2026. But either way, even with that drop, it's still, if you bought it a year ago, it's gone up 7.92% over the course of a year, and you're also getting a twelfth of 5.35% of whatever money you put in, and you're going to get that every single month. So they have the extra dividend date, and they're showing that on here, and it looks like it's the end of the month, and then shortly in April, they'll have the pay date, and that'll give you'll get a dividend on that. Other places to make money where you're not going to get as much of a dividend, but you'll get a little bit of different. But this is places to put money if you want to just invest over a long period of time. If you got more than enough income from your job, if you have if you have enough money that you're making from your work, that then you can purchase mutual funds or ETFs that they don't have low dividends, and they're focused on more NAV appreciation, and this is one of them. This is a Fidelity Zero Total Market Index. It's a mutual fund from Fidelity, and the ticker symbol is FZROX, and this is a mutual fund that basically has it covers the whole stock market. It has large cap, mid cap, and small cap, and it has on here it shows the top 10 holdings. It has the sector weightings. It has technology, financial, consumer cyclical. All throughout the state, like a lot of the biggest companies now are in the technology sector, and so it has a lot of technology, but it also has other types of has everything from basic materials, utilities, real estate, energy, consumer defensive, industrials, healthcare. It has kind of all the sectors. It has non technology companies like Berkshire Hathaway. It looks like the majority of the other top companies now that it holds are all in the technology industry. So over the course of so looking at 1 year, the NAV appreciated 14.6%, and that's over the course of that's starting back in March of 2025, goes all the way to the closing today at 22.92 today, opened at 20 on 3/25/2025. Or even got into the 19th. So it's had some NAV appreciation over the last year, and it's had more NAV appreciation than the Amplify fund. But the Amplify fund pays you higher dividends every month. I believe this like a lot of these mutual funds that aren't focused on dividends, they're going to pay a lower yield dividend, which is this one pays 1.01%. And typically what these type of funds do, the next funds that we'll talk about, or ETFs that I'm going to talk about, they pay quarterly. So they'll pay over the course of a year, you'll get a quarter. Every quarter you'll get a quarter of the yield, 1.01%. So you won't get as much yield, but they're still going to give you a yield. And you can always reinvest the dividends, or you can put those into your, just kind of in your default spot, which would be typically a money market account, and so you can continue to make money there. This one is interesting. They started because it has it's called Fidelity Zero, and that's because it has zero expense ratio, and this is kind of rare. So the inception date was 8/2/2018, and so this has been, it's almost been 8 years that this has been available, there's no expense ratio, so it's kind of odd to have like Fidelity doesn't. You could open an account with Fidelity, and they won't charge you anything to hold that mutual fund. You're gonna have to pay. Sometimes on the mutual funds, the way the mutual funds are set up, you're gonna have to pay a little bit more in taxes typically than you will with ETFs. So anyway, that's an option. Like I said, the difference is you're gonna get paid quarterly, and you're not gonna get as much yield for dividends. But and this is kind of geared for people that have, if you're working a regular job and you have enough income and you want to invest, that's certainly a possibility. We'll look at. And this is one from Invesco QQQ Trust, and the ticker symbol is QQQ. The Qs are technology focused, and they have overwhelmingly technology, 50% technology, consumer services, consumer cyclical, like Amazon. There's some our communication services. There's a lot of like the overwhelming majority of the QQQs are weighted in technology funds or technology equities, and as you can see, the Nvidia, Apple, Microsoft, Amazon, Tesla, Meta, Alphabet, and Broadcom are all considered technology equities, and so they have this ETF QQQ has an expense ratio of 0.18%, low expense ratio over the course of a year, and the yield it'll give you, it doesn't have much of a dividend, 0.46%, and they'll pay that to quarterly, I believe, and this ETF has done well over the course of the last year. It has a NAV appreciation of 19.12%. And again, you're not getting a lot of dividend. So this is kind of geared for people that you're trying to, you don't need income, you don't need more income. You're focused on NAV appreciation, and it's relatively safe. Um, and this kind of goes back to, but as you can see here, the last 6 months, or almost 6 months, 5 months, the NAV has struggled a bit. You're looking at a peak about at 10/29/2025. The peak was 635, and right now we're at 587. So it's dropped a little bit. It's dropped a little, 635 to 587. But if you look at like 5 year, I mean it's kind of, there are different times when the thing drops a bit. For various reasons. Obviously, there was increased interest rates from the Federal Reserve in this time frame, and then then there was some recovery, and then during this whole time frame there was increasing interest rates, people sell off in stocks, and when there's increased interest rates, and then sometimes they buy, like eventually as a money supply and people decide to continue investing in the stock market. Then the NAV appreciates as the money supply increases, and as people get more money from their work or from wherever, and then but anyway, so this is done. Over the course of 5 years, you got 88.81%. That's quite a good return. If you bought 5 years ago, 329.21, at 320 or 315. And now you're almost doubled your money. So this one's done quite well. This is another one from this is a ETF from State Street SPDR S&P 500 ETFs Trust. Ticker is SPY. This one has this is another one that has low expense ratio of 0.09%, and the yield is also low at 1.06%, low compared to the Amplify and the income ETFs that I discussed. But the purpose of this one is for people that have, if you got enough income from another source, you can, if you got an income from a job or from any other source, you can put money into this one, and you can hope to have NAV appreciation over the course of time. Over the course of 1 year, it's appreciated 14.14%. Over the course of 5 years, this is appreciated 68.55%. The S&P 500 is the 500 biggest companies in the United States, public companies in the United States, and there's a lot of technology, but there's also financial, communication services, consumer cyclical. There's everything from car company Tesla, Berkshire Hathaway, Meta. You've got the biggest. A lot of times right now the biggest companies in the world are technology companies, and so it's technology heavy, but it's not as technology heavy as QQQ. There's also energy, utilities, real estate, basic materials, healthcare, and so yeah, you got it kind of spreads the risk out over just the technology. Technology has done very well, and then so yeah, that one's another option that's done quite well over the last year, 14%, and low expense ratio. I believe this one pays quarterly dividends of a quarter of 1.06%. And lastly, I'll look at the VOG, Vanguard Growth Index Fund ETF shares. This is an ETF from Vanguard, and it's focusing on growth. The growth index companies, the biggest companies, or big companies that are growing, or medium-sized companies that are growing. Basically, I don't know if they discriminate on size. Like on here, they have. A lot of times the top 10 companies on here, which is 63.56% of their total assets, they're all large cap companies. Nvidia, and Apple, like all these are large cap companies. The majority of them are in technology, communication services, and consumer cyclical as the majority of these. Has So I mean it's kind of technology heavy as well. The expense ratio is 0.03%, which is really low. The yield and that's over the course of a year, so they're not taking a whole lot of. It's a very cost effective. Vanguard typically has very low cost index funds. Um, the yield is also low. It's 0.44%, and this is also paid quarterly, and you can set this up again where you can reinvest the dividends or have the dividends deposited into your into your brokerage account, and you can then gain interest on the money market account if you wish to do that, or you can reinvest the dividends, up to you. And this is also kind of focused with people who have other sources of income, and if you don't need a lot of income, then you would be open to something like this. And then these companies are all growth companies, and yeah, I don't know that I'm gonna So I think I'm gonna stop there, but like there's so it just kind of gives you places to put money that are relatively low risk. Anything in the anything with equities, you typically want to keep for like over the course of the year, these all have done quite well. Over the course of this past year, they've all done well. That isn't always the case, but the stock market tends to gain more years than it loses. So you could always pick a wrong time pick a bad time to buy, like this time, 2025, and then you have that was the tariffs, and then so there's a little bit of risk involved, but you can usually expect recovery and growth with equities and with stocks in the stock market, with ETFs that hold equities. These are equities. So anyway, that's all I got today. Hope you have a wonderful day, and adios.